This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Let's jump right into it today. The preface for my Trend Following book, the preface for my TurtleTrader book, both of them right now. If you've not read these books, if you've not heard the audiobooks, here's your chance. We'll give you a great start to each book. Again, let's jump right into the preface for my Trend Following book and the preface for my TurtleTrader book.
Preface. Men wanted for hazardous journey, small wages, bitter cold, long months of complete darkness, constant danger, safe return doubtful, honor and recognition in case of success. Want to take the financial journey to a new investing philosophy that might very well affect the rest of your money-making life? I can't guarantee the yellow brick road, but I can promise the red pill will leave you wide awake. In late 2016, the Wall Street Journal reported that Steve Edmondson, the investment chief for the Nevada Public Employees Retirement System, has no coworkers, rarely takes meetings, and eats leftovers at his desk. His daily trading strategy? Do as little as possible, usually nothing. The Nevada system's $35 billion in stocks and bonds are all in low-cost funds that mimic indexes. He may make one change to the portfolio a year. Not exactly a life-changing revelation, I know, but that do-nothing, sit-on-your-hands investing premise doesn't stop with one-man shows. Dimensional Fund Advisors LP, DFA, the sixth-largest mutual fund manager, is drawing in nearly $2 billion in net assets per month at a time when investors are fleeing other firms. DFA is built on the bedrock belief that active management practiced by traditional stock pickers is futile, if not an absurdity. DFA's founders are pioneers of index funds. Now we are getting somewhere, because just about everyone has money tied up in an index fund, which in 2017 is not exactly pioneering. But the much larger issue at hand, unknown to most, is that there is an academic theory that allows anyone to confidently index. The efficient market theory, EMT, states asset prices fully reflect all available information. This means it is impossible for average investors, or superstars for that matter, to beat the market consistently on a risk-adjusted basis, since market prices should only react to new information or changes in discount rates. EMT, set in motion with Louis Bachelier's PhD thesis published in 1900 and developed by University of Chicago professor Eugene Fama, argues stocks always trade at fair value, making it impossible for investors to either purchase undervalued stocks or sell stocks for inflated prices. Let me drop the nuclear warhead on that perspective. There is a mind-numbingly large hole in this cool-sounding theory. EMT, by definition, leaves the epic October 2008 stock market meltdown out of the academic equation. And for those who know about the sausage-making of writing peer-review papers or engineering a PhD, much of modern finance's foundation was bricked together with EMT mortar. Fama was ultimately awarded the 2013 Nobel Prize in Economic Sciences because his findings changed market practice, that is, the worldwide acceptance of index funds. Those findings are the generally accepted status quo. Not everyone, however, is a true believer guzzling the Kool-Aid. One of the first and loudest critics of EMT was famed mathematician Benoit Mandelbrot. He saw EMT proponents sweep big events like 2008 under the carpet, like kids house cleaning for the first time, calling them acts of God. French physicist Jean-Philippe Bouchot sees EMT marketing in play. The efficient market hypothesis is not only intellectually enticing, but also very reassuring for individual investors who can buy stock shares without risking being outsmarted by more savvy investors. Bouchot continues, classical economics is built on very strong assumptions that quickly become axioms: the rationality of economic agents, the invisible hand and market efficiency, etc. An economist once told me, to my bewilderment, these concepts are so strong that they supersede any empirical observation. As Robert Nelson argued in his book, Economics as Religion, the marketplace has been deified. In reality, markets are not efficient. Humans tend to be overfocused in the short term and blind in the long term, and errors get amplified through social pressure and herding, ultimately leading to collective irrationality, panic, and crashes. Free markets are wild markets. David Harding, a man you might not know yet, ratchets up the polemic by describing EMT in apocalyptic terms. Imagine if the economy as we know it was built on a myth. Imagine if that myth was the foundation stone on which the mainstream financial systems that control the global economy have been erected. The great bazaars of stock markets, bond markets, fiendishly complex financial instruments, credit default swaps, futures and options on which the fortunes of billions rest. Imagine if the myth was the key cause of the global crash in 2008, and if its perpetuation today threatened another catastrophic crash in the future. We don't have to imagine. The myth is efficient market theory, EMT. Harding does not have a Nobel Prize, but he does have a net worth of $1.4 billion. He is a flat-out financial heretic and would not be offended if you called him a punk rocker for his anti-establishment attitude. In prior centuries, he absolutely would have been burned at the stake for his wholesale dressing down of the financial high priests. He knows to question EMT is seen as madness by academics, banks, pension funds, and endowments. Interestingly, with a bipolar flair, the Nobel Committee split the 2013 Nobel Prize among economists with radically different theories. Robert Shiller, a man focused more on behavior and who shares the Nobel Prize with Fama, sees the contradictions. I think that maybe he has a cognitive dissonance. His research shows that markets are not efficient. So what do you do if you are living in the University of Chicago? It's like being a Catholic priest and then discovering that God doesn't exist, or something you can't deal with, so you've got to somehow rationalize it. Harding goes further, explaining EMT madness in an everyman way. This theory of rational markets treats economics like a physical science, like Newtonian physics, when in fact it is a human or social science. Human beings are prone to unpredictable behavior, to overreaction or slumbering inaction, to mania and panic. The markets that reflect this behavior do not assume some suprahuman wisdom. They can and sometimes do reflect that volatility. Further translation: human nature isn't rational. It blows bubbles and then pops bubbles. You can see this going back hundreds of years. Dutch tulip mania, 1634 to 1637. The South Sea Bubble, 1716 to 1720. The Mississippi Bubble, 1716 to 1720. The British Railway Mania Bubble, 1840s. The Panic of 1857. The Florida Real Estate Bubble of the 1920s. The Stock Market Crash of 1929. The 1973 to 1974 Stock Market Crash. Black Monday. The Stock Market Crash of 1987. Japan's Bubble Economy and Crash, 1989 to current. Dot-com Bubble, 1999 to 2002. United States Bear Market, 2007 to 2009. Flash Crash, 2010. Chinese Stock Market Crash, 2015 to 2016. Brexit, 2016. And on and on. But it's beyond not rational. Those events, the human actions driving those booms and busts, are best described by academia's prospect theory, cognitive dissonance, the bandwagon effect, loss aversion, and assorted heuristics in judgment and decision-making, to name a few of the hundreds of biases inherent in people's lizard brains. No doubt, the efficient versus not efficient debate will not be resolved in these pages. Perhaps it will never be satisfactorily resolved in an academic mine is bigger than yours sense, which would not be surprising given that human beings and their egos, greed, fear, and money are knotted up so tight as to restrict brain blood flow. And please, don't expect this work to be filled with the latest and greatest macroeconomic bubblegum predictions. You already know that is bullshit completely unrelated to making money, even if you have not yet admitted that fact to yourself. In the face of such chaos, complexity, and human frailty, my curiosity is quite simple. Answer a question. Why does David Harding think he is right, and, more importantly, how in the hell did he get all that money trading the likes of Apple, Tesla, gold, US dollars, crude oil, NASDAQ, natural gas, lean hogs, palm oil, wheat, and coffee, without investing in an index or having a fundamental expertise in any of those markets or the ability to predict directions? That is a worthy question, and the answer is a follow-the-big-money adventure. Trend Following. The 233,092 words in this book are the result of my near 20-year hazardous journey for the truth about this trading called trend following. To this day, it still fills a void in a marketplace inundated with books about value investing, index investing, and fundamental analysis, but lacking few resources to explain how David Harding made his billion-dollar fortune with trend following. Out of the gate, let me break down the term trend following into its components. The first part is trend. Every trader needs a trend to make money. If you think about it, no matter what the technique, if there is not a trend after you buy, then you will not be able to sell at higher prices. Following is the next part of the term. We use this word because trend followers always wait for the trend to shift first, then follow it. Every good trend-following method should automatically limit the loss in any position, long or short, without limiting the gain. Whenever a trend, once established, reverses quickly, there is always a point, not far above or below the extreme reached prior to the reversal, at which evidence of a trend in the opposite direction is given. At that point, any position held in the direction of the original trend should be reversed, or at least closed out, at a limited loss. Profits are not limited, because whenever a trend, once established, continues in a sustained fashion without giving any evidence of trend reversal, the trend-following principle requires a market position be maintained as long as the trend continues. A big reason this conceptually works is seen in the wonky-sounding Bayesian statistics. Named for Thomas Bayes, 1701 to 1761, the belief is the true state of the world is best expressed in probabilities that continually update as new unbiased information appears, like a price trend that keeps updating and extending. New data stays connected to prior data. Think of it chain gang together. Random dice rolls, this is not. Trend following thus aims to capture the majority of a connected market trend up or down for outsized profit. It is designed for potential gains in all major asset classes, stocks, bonds, metals, currencies, and hundreds of other commodities. However straightforward the basics of trend following, it is a style of trading widely misunderstood by both average and pro investors, if it is known at all. Academic literature and real-world investors, for example, have put forth a host of strategies that on the surface appear unique, but at a high level they are all related to trend following. That classic trend wisdom has long failed to be understood in academic circles, that is, until very recently. Notable voices in the academic community have come around to agree momentum exists, the source of trend following profit, but to confuse matters, they describe two forms of momentum: time series momentum, that is, trend following, and cross-sectional momentum, that is, relative strength. I don't see a connection between the two, and I can guess carving out business and academic niches for assorted reasons is in play, but I do know which strategy has produced decades of real performance proof, and it's trend following. The desire to enlighten this state of confusion is what launched my original research and ignited my passion, going all the way back to 1994. My plan was to be as objective as possible, pulling research data from wide sources. Month-by-month trend-following performance histories, hundreds of interviews conducted with subjects from top traders to Nobel Prize winners, published interviews from dozens of trend followers over the last 50 years, details not found on Google, charts of winning markets traded by trend followers, charts of historical markets seen across financial disasters. If I could have utilized only data, numbers, charts, and graphs showing extreme trend-following performance data, that would have been perfect. That is, after all, the raw, unassailable data. Yet, without a narrative explanation, few readers would appreciate the ramifications of data mining. Robert Shiller has said that there is a narrative basis for much of the human thought process, that the human mind can store facts around narratives, stories with a beginning and an end that have an emotional resonance. You can still memorize numbers, but you need stories. For example, the financial markets generate tons of numbers, dividends, prices, etc., but they don't mean anything to us. We either need a story or a theory, but stories come first. Foundationally, my approach to researching and writing trend following became similar to the one described in the book Good to Great, in which researchers generated questions, accumulated data in an open-ended search for answers, and then debated it all, looking for stories, then for explanations that could lead to theories. However, unlike Good to Great, which was all about well-known public companies, to this day the strategy of trend following is still built around an underground network of relatively unknown traders who, except for the occasional misguided article, the mainstream press virtually ignores. And that has not changed in my 20 years. What I attempted with my first edition of Trend Following, and with this newest edition, is to lift the veil on this enormously successful strategy, how trend followers trade, and what can be learned that anyone can apply to their portfolio for profit. Throughout this effort, I avoided institutionalized knowledge as defined by Wall Street banks, brokers, and typical long-only hedge funds. I did not start with J.P. Morgan Chase or Goldman Sachs. Instead, I asked questions across all types of sources and then, objectively, doggedly, and very slowly, and even through some deep-throat help, answers that made intuitive sense were revealed. If there was one factor that motivated me to work in this manner, it was childlike curiosity, where you rip the toy open to find the motor and locate the essence. For example, one of my earliest curiosities was about who profited when a famed British bank collapsed, making the front cover of Time magazine. My research alone unearthed a connection between this bank and a wildly successful trend follower now worth billions. This trader's trend-following track record had me wondering, how did he discover trend following in the first place? I also wanted to know who won when a $2 billion hedge fund collapsed and almost sank the entire global economy. Why did the biggest banks on Wall Street, the so-called smart guys in charge of your retirement, invest $100 billion in this fund when there was so much obvious risk? Further, when I contrasted typical Wall Street losses during October 2008 to what trend following made during the same time in the great zero-sum game, it was hard to grasp why few market players were aware of the strategy. Other questions appeared. How does trend following win in the zero-sum game of trading? Why has it been the most profitable style of trading? What is the philosophical framework of trend following success? What are the timeless principles? What is the trend following view of human behavior? Why is it enduring? Many trend followers are still reclusive and extremely low-key. One who has beaten the markets for over 40 years works out of a quiet office in a Florida coastal town. For Wall Street, this approach is tantamount to sacrilege. It goes against all the customs, rituals, trappings, and myths embedded in so-called success. It is my hope that my narratives, backed by data, will correct misconceptions of winning as a harried, intense workaholic posted 24/7 in front of 12 monitors while downing Red Bull. One of my sources who helped break apart this puzzle was Charles Faulkner. He observed elite traders are almost floating above the world, seeing it from a different perspective than the rest of other market participants. His insights go straight to the core. It doesn't matter what you think, it's what the market does that matters. What matters can be measured, so keep refining your measurements. You don't need to know when something will happen to know that it will happen. Successful trading is a probabilistic business, so plan accordingly. There is an edge to be gained in every aspect of your trading system. Everyone is fallible, even you, so your system must take this into account. Trading means losing as well as winning, something you must live with for success. To adequately explain the genesis of this new edition, I need time travel. You see, my public trend-following persona started in October 1996 with the launch of a simple 4-page website. Armed with a political science degree from George Mason University, no connection to Wall Street or any fund, and with zero academic respect or PhD credentials, it seemed perfectly appropriate to create the first trend-following website. And I did. Loaded with original content, that rudimentary-looking site, TurtleTrader.com, generated millions of views, millions of dollars, and, unbeknownst to me at the time, respect among legions of beginner and professional traders alike. 6 years into that website, I decided it was time for a book, or maybe the book decided it was time for me. Larry Harris, the finance chair at the University of Southern California, randomly emailed me. He wanted me to review his new book because I was driving more interest in his white paper, The Winners and Losers of the Zero-Sum Game, than anyone else. Without skipping a beat, I said sure to a review of his book, but asked for an introduction to his publisher, since I was writing a book too. He obliged and connected me, even though my book at that moment was conceptual. After 2 years of starts and stops, Trend Following was finally ready. And when the first edition hit the streets in April 2004, I had no idea whether it would sell 10 or 10,000 copies. But immediately the book made an under-the-radar splash, landing in Amazon's top 100 of all books. In fact, that first edition was so expected to fail by my first publisher, you could only get it online, initially no bookstore. It went on to sell over 100,000 copies, with translations into German, Korean, Japanese, Chinese, Arabic, French, Portuguese, Russian, Thai, and Turkish. Its success led to 4 more books and the opportunity to direct a documentary film over the course of 2007 to 2009. I never expected an obscure trading book, first written 13 years ago, would lead me to conversations with 5 Nobel Prize winners or face-to-face learnings from trading legends Boone Pickens, David Harding, Ed Seykota, and literally hundreds more. This journey also led me to the world's top behavioral economists and psychologists, from Daniel Kahneman and Robert Cialdini to Steven Pinker. And it opened the door to my podcast, which has run since 2012 and now has over 5 million listens. My podcast has further featured guests ranging from Tim Ferriss to paleontologist Jack Horner of Jurassic Park fame, all connected philosophically to trend-following thinking, at least in my mind. Yet this wild ride has been far more than one-on-one conversations. The serendipity of trend following has led me around the world before live audiences in Chicago, New York City, Beijing, Hong Kong, Kuala Lumpur, Macau, Shanghai, Singapore, Tokyo, Paris, Vienna, and Sao Paulo. A speaking gig in front of 1,500 native German speakers at the Hofburg Palace, the former imperial palace in Vienna, Austria. That happened. And it kept going. Audiences with China Asset Management to Singapore's Sovereign Wealth Fund GIC to regular investor audiences with well over 1,000 people. Everyone from new investor to pro who wanted to learn more about trend following all allowed me to come into their world. But I recall my first public presentation in support of trend following, fall 2004 at Legg Mason's headquarters in Baltimore, where their chief market strategist had invited me to lunch. Afterward, I was escorted up a flight of stairs to a nondescript door. Upon entering the room, I found it filled with young bankers listening to a speaker. Michael Mobison, then Legg Mason's chief investment strategist, motioned for me to sit. I instantly recognized the speaker as Bill Miller, then the fund manager of Legg Mason Value Trust. At the time, Miller had beaten the S&P 500 index for 14 straight years and was easily one of Wall Street's most successful and famed players. Miller then introduced me to the audience. Until that moment, I had no idea I was up next. For the next hour, Miller from one side of the room and Mobison from the other side alternately peppered me with questions about trend following, risk management, and the turtle traders. After the presentation, I thanked Miller for the opportunity to make my case, but wanted to know how he learned about trend following. He said, "I surf Amazon for all types of books. I came across yours, bought it, liked it, and told all my people at Legg Mason they should read it." At that moment, I knew trend following might be catching on a little, at least in some very rarefied circles. Forget sales, which were very good. I knew that if trend following's message had struck a chord with Miller, who was not trading as a trend follower, I might be onto something life-changing. However, it is time to bring this living work forward to 2017 and a whole new audience and generation, for I have barely dented the broad consciousness of global investors. Roughly $80 trillion of investable assets sit squarely at the mercy of EMT inside buy and hold and/or passive index funds, with only 0.25% of assets in trend-following strategies. Almost everyone's savings and retirement monies are literally a slave to wobbly economic theory that leaves the masses unprepared for the next smackdown. That slavery is why I have yet again opened up the chest cavity on trend following. Not outpatient surgery to correct typos, but open heart surgery to add thousands of details. Big picture to minutia that bulk up the original to a new and improved Schwarzenegger on steroids edition. For starters, trend following is now divided into 3 sections. 1. Trend following's original chapters and principles, updated and extended. 2. Trend following interviews, new. 7 interviews from pros illuminate trend following's big picture with the requisite finer details. 3. Trend following research, new. Research contributions that add to the trend following conversation for average investors, professionals, and scholars. This is my most radical and extended volume. Content changes and additions are everywhere. It's now 3 books in 1. I have added material in a way where you can take small steps or go for the deep dive, starting on almost any page. The tone is different too. Toned down in some areas, toned up in others. Some of my younger blank and vinegar was expunged and reformulated to a new mature version, while staying true to the heart and soul of my origins. Last, some might complain that there is too much information, too much content, and I am throwing the kitchen sink at the subject. If so, I will be happy with that criticism. Guilty as charged. Now, if you're looking for guru secrets or easy money riches, please head on back to that OxyContin bender. There is no such thing. If you're in the mood for outlandish predictions, stories about the ultimate gut trader, or what it's like to work inside a Wall Street bank, or if you want to complain life is unfair and beg for the government to save you with a bailout, no one can help you on your path to irrelevance. Or worse yet, if you maintain faith in EMT, steadfastly refusing to consider overwhelming contradictory evidence, maybe you can burn me in effigy along with Bouchot and Harding. If you fit any of these problematic profiles, there's a good chance my words and my politically incorrect perspective will give you an aneurysm. Turn me off now. In the alternative, if you want outside of the box different, the truth of how outsized returns are made without any fundamental predictions or forecasts, this is it. And if you want the honest, data-driven proof, I expect my digging will give everyone the necessary confidence to break their comfort addiction to the box they already know and go take a swing at making a fortune in bull, bear, and black swan markets. Michael W. Covel.
If you like that preface for my trend following book, get the whole book. It's easily available on Audible. And now, without any delay, let's jump right into the preface for my book, The Complete Turtle Trader.
Every morning in Africa, a gazelle wakes up. It knows it must run faster than the fastest lion, or it will be killed. Every morning, a lion wakes up. It knows it must run faster than the slowest gazelle, or it will starve to death. It doesn't matter whether you are a lion or a gazelle. When the sun comes up, you better start running. African proverb. Preface. Trading was more teachable than I ever imagined. Even though I was the only one who thought it was teachable beyond my wildest imagination. Richard Dennis. This is the story of how a group of ragtag students, many with no Wall Street experience, were trained to be millionaire traders. Think of Donald Trump's show, The Apprentice, played out in the real world, with real money and real hiring and firing. However, these apprentices were thrown into the fire and challenged to make money almost immediately, with millions at stake. They weren't trying to sell ice cream on the streets of New York City. They were trading stocks, bonds, currencies, oil, and dozens of other markets to make millions. This story blows the roof off the conventional Wall Street success image so carefully crafted in popular culture. Prestige, connections, and no place at the table for the little guy to beat the market. And beating the market is no small task. Legendary investor Benjamin Graham always said that analysts and fund managers as a whole could not beat the market because, in a significant sense, they were the market. On top of that, the academic community has argued for decades about efficient markets, once again implying there is no way to beat market averages. Yet, making big money, beating the market, is doable if you don't follow the herd, if you think outside the box. People do have a chance to win in the market game, but he or she needs the right rules and attitude to play by. And those right rules and attitude collide head-on with basic human nature. This real-life apprentice story would still be buried had I not randomly picked up the July 1994 issue of Financial World magazine, featuring the article, Wall Street's Top Players. On the cover was famed money manager George Soros playing chess. Soros had made $1.1 billion for the year. The article listed the top 100 paid players on Wall Street for 1993, where they lived, how much they made, and in general how they made it. Soros was first. Julian Robertson was second at $500 million. Bruce Kovner was fifth at $200 million. Henry Kravis of KKR was 11th at $56 million. Famed traders Louis Bacon and Monroe Trout were on the list too. The rankings and earnings provided a crystal-clear landscape of who was making Master of the Universe money. Here were, without a doubt, the top players in the game. Unexpectedly, one of them just happened to be living and working outside Richmond, Virginia, 2 hours from my home. 25th on the list was R. Jerry Parker, Jr. of Chesapeake Capital, and he had just made $35 million. Parker was not yet 40 years old. His brief biography described him as a former pupil of Richard Dennis, who? And noted that he was trained to be a turtle. What? Parker was described as a then 25-year-old accountant who had attended Dennis's school in 1983 to learn his trend tracking system. The article also said he was a disciple of Martin Zweig, who just happened to be 33rd on the highest paid list that year. At that moment, the name Dennis was neither more or less important than Zweig, but the implication was that these two men had made Parker extremely rich. I studied that list intently, and Parker appeared to be the only one in the top 100 advertised as having been trained. For someone like myself, looking for ways to try and earn that kind of money, his biography was immediate inspiration, even if there were no real specifics. Here was a man who bragged that he was the product of the Virginia boondocks, loved country music, and preferred to keep as far away from Wall Street as possible. This was no typical money-making story, that much I knew. The common wisdom that the only way you could find success was by working in 80-story steel and glass towers in New York, London, Hong Kong, or Dubai was clearly dead wrong. Jerry Parker's office was absolutely in the middle of nowhere, 30 miles outside Richmond in Mannequin-Sabat, Virginia. Soon after reading the magazine, I drove down to see his office, noting its lack of pretense, and sat in the parking lot thinking, "You have got to be kidding me. This is where he makes all that money?" Malcolm Gladwell famously said, "There can be as much value in the blink of an eye as in months of rational analysis." Seeing Parker's country office was an electrical impulse for me, permanently dispelling the importance of location. But I knew nothing else at the time about Jerry Parker other than what was in that 1994 issue of Financial World. Were there more of these students? How did they become students? What were they taught? And who was this man Dennis who had taught Parker and others? Richard Dennis was an iconoclast, a wildcatting Chicago trader not affiliated with a major investment bank or Fortune 500 firm. As the locals were fond of saying on Chicago trading floors, Dennis bet his left nut. In 1983, by the time he was 37, he'd made hundreds of millions of dollars out of an initial grub stake of a few hundred. Dennis had done it on his own terms in less than 15 years, with no formal training or guidance from anyone. He took calculated risks, leveraging up huge amounts of money. If he liked to trade, he took all of it he could get. He lived the markets as a betting business. Dennis figured out how to profit in the real world from an understanding of behavioral finance decades before Nobel Prizes were handed out to professors preaching theory. His competitors could never get a handle on his consistent ability to exploit irrational market behavior throughout all types of markets. His understanding of probabilities and payoffs was freakish. Dennis simply marched to a different drum. He eschewed publicity about his net worth, even though the press speculated about it extensively. "I find that kind of gauche," said Dennis. Perhaps he was reticent to focus on his wealth because what he really wanted to prove was that his earning skills were nothing special. He felt anyone could learn how to trade if taught properly. His partner, William Eckhart, disagreed, and their debate resulted in an experiment with a group of would-be apprentice traders recruited during 1983 and 1984 for 2 trading classes. That turtle name? It was simply the nickname Dennis used for his students. He had been on a trip to Singapore and visited a turtle breeding farm. A huge vat of squirming turtles inspired him to say, "We are going to grow traders just like they grow turtles in Singapore." After Dennis and Eckhart taught novices like Jerry Parker how to make millions, and the school closed, the experiment morphed into word-of-mouth legend over the years, supported by few hard facts. The National Enquirer version of the story was captured in 1989 by a Wall Street Journal headline, "Can the skills of successful trading be learned? Or are they innate, some sort of sixth sense a lucky few are born with?" Since the 1980s are long past, many might wonder if the turtle story still has relevance. It has more relevance than ever. The philosophy and rules Dennis taught his students, for example, are similar to the trading strategy employed by numerous billion-dollar-plus hedge funds. True, the typical stock-tip chaser glued daily to CNBC has not heard this story, but the players on Wall Street, the ones who make the real money, know. The inside story has not been told to a wider audience until now because Richard Dennis is not a household name today, and because so much has happened on Wall Street since 1983. After the experiment ended, the characters, both teachers and turtles, went their separate ways, and an important human experiment fell through the cracks, even though what took place is as significant today as then. The effort to get the real story out there started to gain momentum in 2004, when I was invited to visit Legg Mason's headquarters in Baltimore following the release of my first book, Trend Following. After lunch, I found myself in a classroom on the top floor with Bill Miller, the fund manager of the $18 billion Legg Mason Value Trust Fund, LMVTX. Beating the Standard & Poor's 500 stock index for 15 years straight put him in a similar league as Warren Buffett. Miller, like Dennis, had taken extraordinary calculated risks, and more often than not been proven right. On this day, he was lecturing a room full of eager trainees. Out of the blue, Miller invited me to the lectern to address his class. The first questions, however, came straight from Miller and Michael Mauboussin, Legg Mason's chief investment strategist. They were, "Tell us about Richard Dennis and the Turtles." At that moment, I realized that if these two Wall Street pros wanted to know more about Dennis, his experiment, and the Turtles, it was clear a much larger audience would want to hear the story. However, as someone not there in 1983, I knew the task of telling a complete story from an objective vantage, with so many competing characters and competing agendas, was going to be a serious challenge. Getting those who lived the experience to talk, coupled with sleuth-like research to corroborate everything, was the only way to make this story really come alive. That said, behind the scenes, the soap opera of those turtles who worked hard to prevent this book's publication is a saga in itself. Still, the biggest problem with a story like this is that most people don't want to actually understand how the real pros make big money. They want the road to riches to be effortless. Look at the collective public fascination with Jim Cramer, a man who is the polar opposite of Richard Dennis and Jerry Parker. Cramer is no doubt intelligent, but tuning into his extremely popular Mad Money TV show is like watching a traffic accident. There is a live studio audience that hoots and hollers at Cramer's fundamentally driven buy signals and wild prop-smashing antics. In one word, bullshit. That said, a lot of people, many highly educated, believe that Cramer's way is the way to get rich. Instead of employing a statistical thinking toward market decisions, the general public keeps investing based on impulsive feelings, letting an assortment of emotional biases rule their lives. In the end, to their detriment, people are always risk-adverse toward gains, but risk-seeking toward losses. They are stuck. The average newbie investor's method for success is not pretty. He gets in because his friends are doing it. Then the news media start up the stories of little guys doing well during a bull market. They all start to invest by picking stocks with low prices. As the market roars in their favor, thoughts of crashes never enter their mind. With all the money in there, it could never go down. They never see their own slaughter coming, even though their market bubble is never different from past ones. The media tell us that average investors now supposedly understand the concept of risk, yet worrying about possibilities while ignoring probabilities is at epidemic levels. People gamble away fortunes on money-losing hunches or double down when logic says to fold. At the end of a lifetime, they are never any closer to learning how to do it right. But outside of the herd, there are the special few who have the uncanny knack for knowing when to buy and sell, combined with an uncanny knack to properly assess risk. Richard Dennis mastered that uncanny knack by his early 20s. Unlike the general public, wedded to their feelings to make decisions, Dennis used mathematical tools to calculate risk and used it to his advantage. What he learned and what he taught students never resembled Jim Cramer barking stock tips. More important, Dennis proved that his ability to make money in the markets was not luck. His students, mostly novices, made millions for him and themselves. What was the real story, and how did the turtles learn their craft? What trading rules were they taught, and how can an average trader or investor use those insights today in his portfolio? What happened to them after the experiment in the ensuing years? Finding the answers to those questions, with and without Dennis and his students' cooperation, has kept me passionately curious since 1994. I am not alone in that curiosity. As author Stephen Gabriel wrote on Yahoo Finance recently, the experiment has already been done that shows that we can all learn to trade for a living if we want to. That is why the turtles matter. The turtles are an answer to the age-old question of nature versus nurture, the living proof of the single most famous Wall Street school for making money.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, Trend Following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.